Hello, my name is Shalom Hamel. It is now Friday at 9 a.m. New York Times. Since the spring of 1994, I have been working on the inevitable crash and the Deep Depression. I am one of those they call a doomsayer. As things are now evolving fast, I would like today to outline a very probable scenario for the next crash. Long-term interest rates are going down. The yields on the 30 years US Treasury bonds is now 3.93%, much lower than the lowest reached before the Great Recession, which was 4.156%. Technically speaking, everything is in place for an acceleration of the decrease of the long-term interest rate, the Greenspan's conundrum. The rate that would compensate the investor for interest rate risk, the risk that those yields would go up, is 4.6%. That yield would be the fair yield given the present value of Fed funds. Those yields are below the fair value as a result of some irrational exuberance. On Wednesday 7th at 1 p.m. New York Times, there will be an auction on 30 years US Treasury notes. The result of this auction generally gives a shock to the market as the price differ sometimes by a wide margin from the market value of a security before the result of the auction. On the last several occurrences, such auctions have resulted in a sharp decrease of those long-term yields. It is expected that after this auction, the yield on the 30 years US Treasury bond will get in the vicinity of 3.7%. On Thursday will take place the auction of the 30 years US Treasury bond. It will, as usual, give a shock to the market. If the yield on the security is above 3.7% before the auction, it will go down initially. But in any case, we will then discontinuously go up to the fair value of 4.6%, that will create a large downward discontinuity of the price of long-term assets, stocks, bonds, real estate, and of the price of minerals, precious metal, base metal, crude oil. This is what we call a crash.